Hello and welcome to Portfolio Matters, back once again after a week's break. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, I'm afraid we have a big data dump this week because we missed a week and there is a lot going on in the world. Basically, we need to know whether the economy, which has bounced in January, we had very strong payroll numbers in the US, and all the manufacturing and services PMIs, both sides of the Atlantic, were strong in January. Essentially, we're trying to work out whether the economies can recover in the face of rising interest rates, or whether we're going to have recession in the second half of the year. So I think the data is very important at the moment, and we'll be going through it. But first of all, the news. So Jerome Powell gave a speech in which he stated that he will not hesitate to resume 50 basis point rate hikes in order to bring inflation under control. Reminder, last week we had strong inflation numbers, and the inflation numbers we were reporting this week for the Eurozone are again strong. So the market took that badly, and they're now pricing in the probability of a 50 basis point hike at the March meeting in 2 weeks' time, and that led to falling equities and rising T-bill rates. Now, in the last day, we have had a big sell-off in US regional banks and leading to falls in equity markets around the world. Silicon Valley Bank has launched a highly dilutive share offering to restore its balance sheet, sending its share prices crashing. So 2 weeks ago, just after we did Portfolio Matters, PCE inflation came out in the US, and that was unexpectedly strong. It showed a 0.6% rise month on month in January. So it adds to more evidence that inflation is proving persistent. In the EU, CPI, the flash number for February, came out at plus 0.8% month on month. So that is a really bad number, and it shows that inflationary pressures are persistent in the Eurozone as well, and the ECB will need to continue raising rates. China has announced a 5% growth target for 2023 as it recovers from lockdowns. And later today, after we recorded, we have non-farm payrolls for February. Now, the non-farm payrolls will reveal whether the January numbers, which were very strong, were aberrant, whether the seasonal adjustments were too strong. And the coming non-farm payrolls and inflation numbers, which will come out before the FOMC meeting, will determine whether the Fed raises by 50 basis points or 25 basis points. So that's something to watch. So this is PCE service inflation in the US ex-housing, and that's the Fed's preferred measure, and it was not reassuring. In January, it came in at plus 0.58% month on month, way too strong, and not compatible with the Fed's 2% target. Hence, the markets are now expecting the Fed to raise rates further for longer. And they're pricing in a 50 basis point rate rise at the next FOMC meeting in 2 weeks' time with a 65% chance. And they're now expecting the Fed terminal rate to be 5.6%. So they're pricing in another 100 basis points of rises over the coming quarters. And this is what's happened yesterday. So Silicon Valley Bank which is Californian banks specializing in lending to the venture capital industry and to startups, they have issued a whole load of shares diluting their current shareholders in order to restore the balance sheet. And the fundamental problem is that we have an inverted yield curve. So short-term rates, i.e. their funding costs, are higher than the rates they lend at. And so these regional banks are being squeezed, and Silicon Valley Bank has a particular problem because its venture capital clients are burning through cash, which means they're withdrawing money from the bank. So the deposit base is declining. They've also lost a lot of money on their bond holdings. They have bond holdings of $91 billion. And obviously, as rates have risen over the last year, so the value of those bond holdings has declined. Regional banks in the US are being squeezed by an inverted yield curve. This won't be the first regional bank to get into trouble. China has announced a 5% GDP growth target for the coming year. As you can see from this chart, the growth in China has been declining from extraordinary levels in the early 2000s. In the Eurozone, QT has started. The ECB will now be reducing its balance sheet by 15 billion euros a month until June. Okay, on to this week's economic data, and I'm afraid there is a lot of it. Starting with the UK, well, house prices are falling. So we've had the nationwide house price index year on year that fell by 1.1% in February, missing expectations. Mortgage lending was also down in January, missing expectations, but mortgage approvals beat expectations and appear to have been really quite resilient. So mortgage approvals were 40,500 and they only fell by 1,000, which was less than the market had been anticipating. So more home buyers than you might think, given very high interest rates. Retail sales in February continued to beat expectations. So the UK consumer is resilient in the face of rising mortgage rates. And UK GDP, again, showed resilience. The latest figures as of this morning showed that the UK economy actually grew by 0.3% month on month in January, beating expectations and much better than December. Year on year, it was flat, again, better than expectations. Industrial production declined in January and was down 4.3% year on year, but that was better than expectations. Construction output is slowing. It was 3.7% year on year in December. It's now 0.6% year on year in January, missing expectations. So we have been forecasting that UK construction output would slow, and it appears to be doing so. Moving on to the Eurozone, we had sentiment and expectation data from the ECB, and economic sentiment faded in February. Quite important. It bounced in January, and we were expecting that to continue. It didn't. It faded slightly. Consumer confidence hit expectations, but is still poor. Services sentiment faded again, as did industrial sentiment. So in the Eurozone, it looks like the strong bounce in January faded a bit in February. Now, the important numbers were inflation, and they were not reassuring. Inflation was persistent, and actually core CPI grew in February. It's now 5.6%. up from 5.3% in January and massively missing expectations, not reassuring. We'll show you in a bit that the market now has 10-year inflation expectations for Germany, which are above those for the US. So the ECB is losing credibility in the market. And on to the US. Now, 2 weeks ago, we had PCE inflation data, which was just shockingly bad. So month on month in January, it was up 0.6%. Really bad number. And then the year-on-year number again missed expectations by a decent margin. And the core PCE also grew at 0.6% in January, double expectations. So inflation in the US is not coming down, not what the Fed wants to see. Pending home sales had a surprising bounce in January. We will go into that later. We have some charts for you. Then we had the ISM manufacturing and non-manufacturing PMIs. Now, the manufacturing PMIs showed that in February, the bounce in January seemed too slow. So the headline PMI missed expectations, although it was up on January. Employment fell and fell below 50, missing expectations. New orders, though, showed a strong bounce, though they were still below 50. And unfortunately for the Fed, prices paid actually rose much more than expectations and rose above 50. So on balance, manufacturing companies were reporting that they were paying higher prices for inputs again, not what the Fed wants to hear. In the non-manufacturing sector, actually the headline PMI was better than expected, but down on January. Employment rose very strongly. Again, not reassuring for the Fed. New orders showed an enormous rise above expectations, now at 62. That's a very good number, but prices paid missed expectations, but was still very high. Okay, moving on. Construction spending in the US in January missed expectations and fell 0.1%. Are we starting to see the slowdown in the construction sector we have been forecasting for a long time now? So later today, we have non-farm payrolls. Earlier in the week, ADP had their numbers for February, and they continued to show strong jobs growth, up 242,000 on the month, beating expectations. So if non-farm payrolls follows the ADP numbers, it shows that the US employment market remains very tight. Now, the JOLTS job openings show that in January, the number of jobs openings fell, but fell less than expectations. So more evidence of a tight jobs market, and the jobs cut numbers actually came down. So announced job cuts from US corporations was lower in February than in January, and that missed expectations. Finally, on to China, and we had PMI data, and take a look. It was all really good. So non-manufacturing PMI bounced to 56.3, and that is a strong number. And the general also beat expectations and came in at 56.4. So Chinese economy is bouncing back, seems to be doing well. Some charts, Richard.
Thank you, Keith. So this is the month-on-month UK GDP. So we sort of see it sort of bouncing around, slightly positive to slightly negative. And the year-on-year GDP growth inching its way above recession at the moment.
Yeah.
The UK industrial production, fairly sad graph. And month-on-month.
So that weak bounce we had over the last quarter seems to have faded again.
Yeah, it does, doesn't it? And it's just a steady decline, actually, which is really, steady decline over the past year.
Yeah.
So, right. And UK construction expenditure, I mean, I would expect this to go well below zero, because you see so much construction in London, and you just think, who's going to be the tenants for these vast office buildings that are going up?
Yeah.
So UK mortgage lending falling.
Yeah, I'm surprised that it is as resilient as it is, given the very high mortgage rates. I think this will just keep on falling.
Yeah, I think one of the things we're seeing is that the economies generally react quite slowly to rising interest rates.
Mm.
But presumably that means that they continue to respond to them well after the rises cease.
So when you agree to buy a house, Richard, what's the general lag between kind of agreement, getting your mortgage, and actually, completing?
So it's about 3 months, and if you go for a fixed rate, basically the mortgage company will guarantee the fixed rate for a period of time to give you certainty prior to completion. So sales now will probably have had the mortgage rate set about 3 months ago. It would be my bet.
Right. Okay.
Mortgage approvals dropping. Now, whether that's probably a combination of lenders tightening up their criteria and fewer applications.
Yeah. Actually, that is well down from its peak in the pandemic.
It's a big drop, isn't it? It's a third down, actually, on the sort of on the norm pre-COVID. The UK mortgage rate still climbing steeply.
Yeah.
7% now. And that's, I don't know what you have to pay if you refinance. If you're refinancing for a fixed rate, it was 3.5%. But you're going to be refinancing at something significantly higher. It's got a big hole in your household finances. And that's going to come out over the course of the next few years.
Precisely. Reminder, around 4 million UK households will have to refinance their mortgage over the coming year.
It's a lot. EU CPI, I think we have to wait and see where that goes from here. I think it's too early to say that it's falling consistently.
I think it will come down, Richard, but the question is how slowly it comes down. I think.
And what level does it come down to? I suspect it's not going to come down to 2%. But I mean, the problem with the economy, the world economy, there are so many moving parts, and so many of them are moving in different directions. Making predictions is extremely difficult.
Well, I think the ECB needs to raise rates higher for longer, and it's been much slower than the other central banks, and now it's playing catch up. And how quickly EU inflation comes down will depend on how committed the ECB is to the fight.
But of course, we have this problem we've spoken about forever, which is that the peripheral members of states can't afford higher government debt interest rates. So when they refinance at higher rates, they can't afford it.
Yeah, but again, that's the dog that hasn't barked. Italy, which is the problem child of the Eurozone, its bond yields actually have not risen anywhere near as much as we had expected. And the market seems very complacent about sovereign bond risk in the Eurozone.
What is the EU doing with its balance sheet currently, Keith?
So it is not reinvesting bonds that mature.
So it's not really tightening. It's letting it run off a little bit.
Yes, that's right.
So month on month, EU CPI with that figure that Keith referred to, 0.8% in February, which is not good at all. Annualized, of course. You can't just annualize 1 month, but annualized it would be 10%.
Yeah, a very, very bad number.
Yeah, EU core CPI, which is it's continuing to head up in that really straight line. And the EU economic sentiment is actually, I think it's holding up remarkably well, given the global circumstances, the war in Ukraine and so forth.
I think that's true, Richard. But I mean, over the last few months, I think you could say that the bounce has been caused by falling energy prices and the fact that, there's been no spillover from the war in Ukraine. The energy crisis everyone had been expecting just didn't occur. But now I think that's fading. Yeah. Let's see what happens over the next few months.
That's right. So, I mean, I was expecting the EU to go to be well into a deep recession by now, and it has avoided it. So,
yeah.
EU consumer inflation expectations have dropped back down to pre-COVID levels and are really quite low, actually.
Yeah.
Somewhat in the face of reality.
Well, clearly, the average EU consumer is not watching Portfolio Matters and seeing that relentlessly rising core inflation number.
We'll have to start translating it into German, Keith.
Yeah, you can do the talking, Richard.
I'm afraid my German is limited to 1 or 2 weeks sleep.
Didn't you watch Hello, Hello?
That was French and German, wasn't it,
Well,
Keith?
okay. Well, I think you're fully qualified now.
EU selling price expectations. So this is this means that producers are expecting their price increases to fall. These rate of change graphs can be quite confusing. You have to get your head around them. And EU consumer confidence is still low, but is improving quite rapidly.
Yeah, it's still a bad number.
And EU services sentiment is actually fine.
Yeah, that's an absolutely fine number.
Yeah.
It's surprising.
And EU industrial sentiment is also, it's a little bit sort of lowish, but it's not, there's nothing problematic with it. Look at 2016.
Yeah.
US ISM and manufacturing PMIs are a slight tick up, but the trend hasn't changed yet.
I completely agree. You know, we've had months before where we've had a 1 month tick up and then it's just continued down. And frankly, I expect that to be the case.
Yeah. ISM employment is around about neutral. Manufacturing new orders have improved. Keith referred to that when he was going through the tables. And manufacturing prices paid have perked up a bit. And non-manufacturing PMIs had that really sharp downturn, didn't they? But that looked like it might have been a bit of a blip.
Yeah, we have talked about this previously, but the S&P Global Services PMI, which should be the S&P's version of the ISM non-manufacturing, paints a much less volatile picture of services, and their PMI is much worse than this and doesn't have all this noise. And S&P Global claim that theirs is much better constructed than the ISM.
Yeah, I mean, this one is showing if you ignore that steep blip recently, it's showing just a gradual decline, isn't it? But it is very noisy.
But 55 is, you know, a good number.
Yeah. And ISM non-manufacturing employment is fine. And we have the strong payroll numbers. I mean, we have to be careful of those payroll numbers because there are so many seasonal adjustments in them. And, you know, commentators queried the validity of them. I don't know enough about it to be able to query the validity, other than to say some people do.
Well, the thing is, Richard, there was a 3 million seasonal adjustment to that. And today, when we get the February numbers, that will have to go negative in part. So, you know, we'll find out how much of the non-farm payrolls in January was illusory later today.
Yeah, we will. US ISM non-manufacturing new orders, that sharp spike upwards.
Yeah, those look good. That's a good number.
Yeah. And non-manufacturing prices paid continuing to steadily decline. US personal income growth month on month, fairly typical month. And US jobs, the job openings, staying, as far as the Fed is concerned, stubbornly high.
Yep.
And as this chart says, continuing to beat forecasts. It's risen above the pre-COVID trend, and currently it's staying there. LinkedIn hiring rates falling sharply, so a little bit of contradictory data here. I don't know how contemporaneous this data is, Keith.
No, I think this is really contemporaneous. But I think what's going on here, Richard, is that the JOLTS looks at the whole economy, whereas I think LinkedIn is mainly white-collar work.
Yeah, I would say it's probably white-collar private sector.
Yeah. So what we're seeing is that, you know, the middle classes, those middle-class jobs, those companies are cutting back. We know tech in particular has been cutting back, but you know, the service sector, if you're in restaurants, etc., they're still looking for people. I
mean, actually, that chart is not a happy chart, is it? It's gone from 40, plus 40 to minus 40.
Exactly. No, I was really surprised by how negative this was.
Yeah.
But
and it's very well below the period of 2016 to 2020.
yeah, no, this doesn't seem compatible with, non-farm payrolls, etc.
Yeah. And of course, there are no seasonal adjustments in this. It's just the data.
Yeah.
There we are. That's basically what Keith and I were talking about.
Yeah. So despite the very strong payrolls number, we are getting other data based on, contemporaneous internet data where you can monitor it live, showing that actually, particularly for white collar jobs, the employment market is weakening very significantly.
Yeah. Well, we're also getting quite a lot of layoffs from the banks, the tech sector, aren't we? So that's got to filter through.
Yeah.
So the quits rate is falling, which suggests people feeling a little bit less secure in their jobs.
Yeah, but it's still very high, frankly.
US personal spending month on month, basically, everybody went out and had a blast, didn't they, Keith?
They did. No, this is a really strong number.
I wonder what
that in a bit.
Yeah, I wonder what the sort of excess savings is now, whether they're working their way through that.
No, it appears to be that the US revised the tax bans, amongst other things. And actually, there was this one-off boost from a reduction in tax revenues. But that will fade in coming months.
And everybody's gone out and spent it.
Yes.
Very sensible too. US PCE inflation month on month, so 0.6% month on month inflation, which is chunky.
Yeah, not good.
And that's the year-on-year figure. And the core PCE inflation is also quite chunky. And you can see why the Fed's panicking a bit, can't you?
Yeah, it's not coming down anywhere near as much as forecast.
Exactly. And there we have year-on-year, which is sort of plateauing. 5. The US Dallas Fed manufacturing index is lurking around minus 15 to minus 20.
But you notice that bounce in January didn't last.
No. And the Richmond Fed manufacturing index painting a similar but not identical story of it not being a strong reading at all, some contractionary reading. And the service index just below zero, staying below zero for Richmond Fed.
Yeah, and I would contrast this with the ISM. It's saying conditions aren't great, whereas the ISM is saying they are great. So we're getting quite a lot of contradictory data.
We are. And the ADP employment change, which was positive 242,000. And again, what the Fed wants to do is it wants to see that figure going negative. We've got these huge seasonal adjustments that we've referred to. So I suspect they are, with this one, they're driving forwards by looking out of the rear screen, aren't they?
Yeah, but again, when we look at the ADP, we've just seen the LinkedIn numbers, which show that, firms are cutting back on hiring. And there's just loads of contradictory data.
There is, but also, unless I misunderstood this, this report is based on the actual payroll data from 25 million employees. So, yeah, I mean, it's non-farm private employment. It is, we would have expected to be similar to the LinkedIn, vice versa, but they're clearly different.
Precisely.
US building permits continuing to fall, really, and new home sales holding up quite strongly. Yeah,
and these are month-on-month numbers. Okay, so in January, they rose 7.2%, and then they rose again in February. And given the rises in mortgage rates and the all-time low in home affordability in the US, this is really surprising.
And US new home sales picking back up in the last reading, again showing unexpected, I think, strength in the US housing market.
Yeah.
And likewise, US pending home sales very strong.
So we have a couple of sections coming up on US housing where we will attempt to make sense of this.
And the US pending home sales year on year, basically now reflecting those strong figures from the last couple of months. The house price, Case-Shiller house price index month on month continuing to fall gently. And there we have the year on year figure, which the rate of increase is now reverted back to what was the normal rate of increase for the period 2012 to 2020.
Reminder, the Case-Shiller just looks at houses that have been sold previously. So it compares the latest transaction with previous transactions. So there is a bias away from new homes to existing homes.
US construction spending is still weak, month on month.
But actually, down only 0.1% month on month.
Yeah.
At some stage, I'm expecting quite big month on month falls in this.
And the US MBA 30-year mortgage rate around about 6 to 7%, twice and a bit more what it was a year ago. And the US MBA mortgage market index, as low as it's been on this chart.
Yeah. And again, how do you explain this and the rise in new home sales the last couple of months? There's been no rise in mortgage rates. So that must mean there's been a lot of cash buyers buying new homes.
Yeah.
How long? That can't last forever.
No, that's a good point, Keith. So US retail sales year on year, continuing their decline from last summer. A fairly dramatic decline. And the initial jobless claims weekly is picking up sort of gently, but it's not showing any different shape to previous points in the graph at the moment.
Yeah, that's a 1 week figure. So, let's see what happens over the coming weeks.
US continuing jobless claims, stable at around about the December figure.
Yeah, it's too early to tell whether that's a sustained rise.
Yeah. China manufacturing PMIs surging ahead with the release of lockdown. I mean, I suspect it actually is surging from much lower point than 45 or 47. And the Chinese non-manufacturing PMI is doing the same thing. And the China NBS general PMI, China is surging out of lockdown and undergoing a sort of economic revival at the moment.
Yeah.
So we can summarize all of that lot by saying that UK GDP risen in January, probably helped by falling energy prices and narrowly avoiding going into a recession at the moment. UK housing market is slow, mortgage rates continue to rise, and the EU inflation is proving persistent and must be very worrying for the central bank. And core CPI rose to 5.6% year on year and ahead of expectations. They'll all be busily redrawing those graphs, Keith. Right angle come off a month later.
Yes.
Yeah. So US inflation is proving persistent, and we know that from the evidence that the Fed chair gave to Congress the other day, that he is very worried about this. US home sales had an unexpected bounce in January. US February's PMI is proving stronger than expectations. The economy is proving resilient. The Chinese economy, which is the second biggest economy in the world, so will have significant knock-on effects, is recovering well.
Yes. Okay, thank you, Richard. On to one chart. And we're talking earlier, Richard was saying about how UK homeowners who have to refinance their mortgage as their old deal ends will find that they're having to pay much higher rates. Now, this is from Stuart Owen, our third member of Portfolio Matters, and this is from one of his properties. And actually, it's from back in October when rates in the market were lower than they are now. So his monthly payments in this month will be significantly higher than they were in October. So what happened was that he was on a 1.94% fixed deal. And now, when that expired, he's gone onto the variable. And his monthly payments went from £560 a month to 1,750. Now, we know that during this year, 4 million households will come off their existing mortgage deal and have to refinance at existing mortgage rates. So a lot of UK households will be facing exactly this shock rise in their mortgage payments. And that will mean they'll have to divert spending from their household budget to paying the mortgage, and that should reduce demand and slow the economy.
That is seriously bad news for households that are tight in terms of their disposable income.
Absolutely.
That's very dangerous.
And we know that the current energy subsidy scheme, the price cap, expires in March, end of this month. And what's the government going to do? If the government does not extend that, then energy prices are expected to rise again in the market before they fall in the summer. So a lot of households are going to face very squeezed budgets. And hence, the Bank of England has been pushing back on market expectations that it will need to raise interest rates much higher, because actually the economy is evolving in line with their expectations, and over the course of the year, higher rates should slow the economy and bring inflation under control. And onto Inflation Watch. Now, the only numbers we have new are for the EU. Reminder, these are flash numbers, so they are the first estimate. And CPI fell very slightly to 8.5%, way above the 2% target. Core CPI continued to rise to 5.6%. Turning to the US, if you look at the far right-hand column, which I've highlighted, and you look at the annualized 1-month change in PCE inflation, it's really, really not reassuring to the Fed. The 1-month change in PCE was 7.7% annualized. So there's little evidence that inflation is coming under control in the US. The trimmed mean was 6.3%. So we're still having broad-based inflation in the US well above target. And PCE inflation rose in all categories in January. So goods inflation rose as well as services. And we've been expecting goods inflation to keep on declining. Well, it bounced in January. Service inflation, there is no evidence there of a downward trend, sadly. And wage growth in the US in January continued strong. But pause and take a look at this chart. This is wage growth in the hospitality industry, leisure and hospitality. And we know that that is a sector that has been struggling to find workers, and last year was paying extraordinary wage rises. In 2021, it was paying 27% year-on-year wage growth. Well, that has faded a lot, and that is reassuring, although you'll notice that it's still 7.2% year-on-year, but month-on-month, it's just 0.7% in January. So that is good news. But in February, US small businesses, our wage growth was 4.9% annualized, and workers are working longer hours. So again, there's demand for labor, and adds to a picture of a tight labor market and persistent wage growth. But Russell 3000 companies are no longer complaining about labor shortages as much as they were. Only 4.9% of them were complaining about that in Q4 compared to 16.5% in Q3. We have some contradictory data here. So this is the Morgan Stanley Supply Chain Index, and it has been brought forward by 4 months. And that's the blue line. And you'll see that it is showing an increase in supply chain difficulties over the last 4 months. And they are then saying that that should mean that goods inflation is persistent. But if we look at the UBS supply chain stress index, it's continued to fall. I don't know how you square those two.
I think you can. I heard someone apparently pre-COVID, $30 billion of goods a month were leaving China, being exported from China, and now the figure's 50 billion.
Yeah,
which suggests that just in the context of shipping, that you would expect that there is high demand for shipping. But some of the shipping figures suggest that demand's falling off a cliff. There is so much contradictory data around that it's really, really difficult to work out what's going on.
Well, we know that prices for shipping have fallen off a cliff and that there's a load of container ships coming down the pipe. So, I think you'd expect supply chain pressures to ease over the course of this year as those ships come into service. Now, this is also from Morgan Stanley, and this is their supply and demand index, again, brought forward by 4 months, and that is falling. So that suggests that goods inflation should continue to fall. Really interesting. Pause and take a look. This is Eurozone inflation, and once again, it shows the divergence in experience across the Eurozone. So the ECB has the task of setting monetary policy for an area where Hungary is experiencing inflation of 26%, whereas Luxembourg is only experiencing 5.8%.
Tricky.
Yeah. Well, one thing we know is interest rates of 2% are not appropriate for either of them.
Yes, very true.
So Eurozone core inflation not yet coming down. The headline inflation is, but is still way too high. And as we saw for the last chart, that's the average.
Exactly, yeah.
Food prices fell again for the 11th straight month. So that is also good news for inflation. And the bottom line is that disinflation in the US is happening. It's just much slower than hoped for. And 1 month's bad data does not break that trend. We await data. The data is really important now because a lot of our commentators are expecting there to be essentially no recession on the US economy to keep on growing. Now, we don't expect that. We expect the economy to go into recession in the second half. And the data will decide who is right. So in summary, inflation is not falling as much as we would hope on both sides of the Atlantic. And actually, services inflation is particularly sticky. In the Eurozone, you've seen that core inflation is still rising. However, CPI is falling. Supply chain disruptions are over. Food inflation is continuing to fall. Energy prices are continuing to fall. And goods inflation should fall. So over the coming months, you would hope that inflation will come down. Monetary policy operates with a lag. We saw earlier Stuart Owen's mortgage payments. As debt needs to be refinanced, so money will be diverted away from profits or from other spending to debt servicing, and that will reduce demand and slow the economy. Okay, on to recession watch, Richard.
So corporate profit margins have fallen back to their trend line from 1990. The question is, what happens now? Will cost cutting start to ensue, which obviously would mean job losses? And the general overall level of profit margins is still elevated. And obviously we saw that trend line. And there's this argument of capital versus labor, isn't there, Keith? And labor has been squeezed. And if labor starts to reassert itself as a more dominant factor in industry costs, then we'll see that these profit margins are reduced substantially over time.
Yeah, but again, there's contradictory data between these two charts. This data comes from the companies themselves, and this comes from the national accounts. And so in one, they're saying profit margins are back to normal. And then the national accounts are saying, well, they're not. We just don't know.
US manufacturers seem to be hoarding jobs, so they don't want people to leave, because if they lay them off, they may not be able to re-employ them. They're trying to hedge their bets, really. And what that does mean is that if the economy doesn't start to grow, then there may be a flurry of layoffs where basically companies pull the trigger on reducing their headcount. On the other hand, if the economy shows signs of resilience, then that trigger won't be pulled. Again, everything is a bit up in the air at the moment. And so we've got corporate costs rising faster than sales. So that would explain the margin squeeze. Obviously, if they're keeping headcount high, then their costs will be rising due to inflationary pressure, and the sales are not rising. So there's a significant margin squeeze there, which supports the margin squeeze as opposed to the absence of margin squeeze. Mind you, isn't the absence of margin squeeze data, isn't that inevitably a year out of date, roughly speaking?
I don't think so. I think it's quarterly. So this is, you're right, it's last Q3 is the latest data point. So there is a lag, but it's not.
So they're picking it up from quarterly reporting, therefore, aren't they? Which is they're picking it up from listed companies. They're not picking it up from the economy as a whole.
Yeah.
I mean, they may well, yeah.
I don't know, actually, they're probably, I don't know quite how they're measuring that.
No, must be from quarterly returns, stock market reporting, I would guess.
Well, no, national accounts data, which would include all companies, not just listed ones.
Yeah, but all companies don't report quarterly, Keith. They don't.
Yeah, no, that's true. That's very true.
I don't know. US small business job creation ticked up a little bit in February. It is extraordinarily, it's an extraordinary graph, isn't it? You've got the great financial crisis and COVID, and then a sort of island in between.
Yeah.
And US bank deposits shrank in 2022. Well, sorry, what does that suggest, Keith? Sorry.
So what it means is if bank deposits are falling, then the only way that you can generate inflation is by corporations redistributing existing money towards workers through higher wages. And that would then reduce profits.
I don't think that's true.
I don't think that's true either, because actually you can still generate inflation, but if you move the money around faster. So if the velocity of money picks up.
That is a particular source of inflation, only works if, but there are many elements to inflation. So
yes, that's why I put it commentary. This is from Florian Kronawitter, who I like, but in this case, he suggests there's this.
It's a very narrow perspective.
Yeah.
Try telling that to the Germans in 1930s.
I think the money supply was growing very quickly there, Richard. Anyway.
Yes. But it wasn't bank deposits, was it, Keith? It was wheelbarrow deposits. Yeah. Anyway, yeah. So consumer spending was very strong in January, as we discussed, possibly due to a significant change in the way personal taxes are calculated. Came into effect in January. So probably that's just a one-off.
Yeah, this just seems extraordinarily high. And the commentary is that it was due to changes in income brackets in the US. So, you've had higher inflation, but they have cut the income brackets, or they haven't changed. And so you've had this, reduction in real taxes.
We've seen graphs like this before, and this one is now showing that the bottom 40% of the US income distribution have largely used up their pandemic savings, whereas everybody else still has a decent chunk left. And when you include consumer debt in that calculation, only top 20% are better off now relative to pre-COVID.
Yeah, this is really important. actually, because we've talked many times about how consumption in the US has been supported by the fiscal largesse in the pandemic. And actually, once you account for debt, the bottom 80% of the population have used up all that savings from the pandemic, which means that spending should start to slow because the top 20% largely save that money.
Yeah. And the US savings rate is beginning to normalize after COVID, which suggests that consumers have exhausted excess savings and want to increase the level of their savings back to sort of pre-pandemic levels, which again reduces consumer consumption. And interest rates on credit cards are their highest ever. The phrase usurious and banker comes to mind. A lot of consumers already seem to be struggling with their debts. And this is a really quite frightening graph, I think, where we have the debt delinquency rate has doubled, more than doubled in less than 12 months.
So now you're seeing this spiral whereby credit companies are raising their rates to compensate them for higher losses. And that further stresses heavily indebted US consumers.
Yeah, good point. So banks are tightening lending standards and raising loan rates so as to avoid incurring loan losses, which makes borrowing harder in the economy, which again is another factor which will cause it to slow down. But all of these things take time to come through.
Yeah.
And consumers are becoming increasingly pessimistic about their personal finance outlook. That's a pretty dire reading, isn't it?
Yeah. And not what you would expect if they'd all had, good savings and good job prospects, wage growth, etc.
And the Fed's probably going to put interest rates up by another 0.5% today.
Well, in 2 weeks' time. Yeah.
2 weeks' time, yeah.
Well, that's what the market is currently expecting. But I think a lot depends on non-farm payrolls later today and then inflation next week.
So we know that a great deal of debt is going to be refinanced at significantly higher interest rates. We just saw that with Stuart's personal refinancing. And we know monetary policy works with a long lag. Now, I heard something interesting yesterday, which is that the Fed is going to have to start funding US debt issuance again in the autumn. And it is desperate to have interest rates reducing by that point. Otherwise, it will be doing QE and raising interest rates simultaneously. And that one of the reasons for having a rapid increase in interest rates now is to put them in a position where they can start to reduce them in the summer.
So why would it need to do QE again in the autumn, Richard?
Because US government debt will need financing.
Yeah.
Because of the roll-off of
I see, right.
Debt and the taking on of high. So basically the interest bill goes up massively, not to mention the fact that the US government is constantly borrowing more and more money.
Yeah.
And if they don't monetize it, then there isn't sufficient capital, there isn't sufficient cash in the economy to pay it without pushing the economy into deep recession. I mean, they are in a real bind, whichever way you look at it, and whether you think that theory is right or not. There's this bind between excessive debt rates, excessive debt burden, excessive interest rates, and the economy being unable to afford the debt burden that is there, and they're trying to muddle their way through it.
Yeah, well, we've talked about this many times, but I think it's absolutely right, because that's the thing. The more indebted an economy gets, it just can't afford higher interest rates.
Yeah, and that's exactly where all these economies are getting.
Yeah. So hence, I think you're right. The Fed, central banks, need to show their inflation-fighting credibility to get long-term rates down so that the debt becomes affordable.
Yeah.
Otherwise, if they fail to do that, then rates rise on long-term debt and the country goes bankrupt, basically.
Yeah, they basically have to start monetizing government debt again. And whilst they've got high interest rates to address inflation, the whole thing just sort of becomes a total contradictory mess. Well, it already is, but
yeah,
it starts to become.
No, I agree. So they need to get inflation under control and real rates down,
and they need to do it really quickly. And I think that's why Powell is now panicking,
Well,
I
I
think
think also thing is that easy to underestimate the debt raising capacity of the economy, because what will happen is that as government bond yields rise, they become increasingly attractive, and so actually savers, there's immense amounts of savings in the economy. Savers can divert their money to buying government bonds, but that sucks money out of the economy and causes a recession.
Yeah, that is true, Keith. That is true. Yeah. So according to the Atlanta Fed, moving on, the economy is doing just fine, apart from the fact it's got quite high inflation.
Yeah, no, absolutely. The contemporaneous data in the US is still remarkably strong.
This is a Goldman Sachs Twitter Economic Sentiment Index, which is tracks quite nicely the Michigan Consumer Sentiment Index, and it is now neutral, which suggests that the light blue Michigan Consumer Sentiment Index might continue its rise back up towards neutral.
Yeah, surprising actually.
Yeah,
I don't know how they calculate it, but they were seeing lots of data that suggests actually the US economy is doing just fine.
and there we are, and then we have leading economic indicators showing a significant downturn. So it's been contradictory data.
Yeah, well, the economy is doing much better than we had been expecting, but also than objective measures, leading indicators forecast it would.
And here we have a chart that suggests the leading indicators always peak before a recession, and they appear to have peaked. So are we entering into a recession? Well, we'll see, won't we?
Yeah.
But, this one seems to be slightly defying some aspects of recession at the moment.
Yeah.
My view is that we is going to go into a recession, because with these interest rates and the long-term nature of their operation, it's going to damage the economy. But I think it's taking a long time. There are still 5.1 million more job openings in the US than there are workers to fill them.
Yeah.
Inflationary pressure.
Now, there is the question unresolved we've been asking for a long time now about how many of these jobs are real, because we know that the job survey is only is getting fewer and fewer responses, and there's no cost to leaving advertisements open for jobs if you can't fill it. And so a lot of these job openings may be stale. We don't know.
Tech layoffs, we've all read in the news, have been rising sharply. And I suspect that we haven't seen the end of it yet. And US money supply growth turned negative for the second time in a century. And every time that's happened, there has been a big recession. My only comment there, I'm not an expert on this, is that US money supply growth was so enormous that does it turning negative now have the same impact as it would have done previously?
I completely agree with you. I completely agree with you. I think it's very difficult drawing these analogies with history, but you'll see that the other times when there's been a sharp recession, monetary growth in the previous year wasn't that great. So contracting monetary supply was a big shock. Whereas when you've had money supply growth of 26%, you're just surely taking some of the excess out of the economy.
Exactly. So, yeah. UK landlords selling off their properties as rising mortgage rates makes them unprofitable. Also, the government over the last 10 years has made owning property to rent out as a private individual less and less attractive as a business proposition.
Yeah. No, I was really surprised. I didn't know this, that you can only deduct 20% of your mortgage interest rate cost from when you're declaring your tax. So, it just doesn't work for a private investor who is attempting to buy buy-to-let properties using debt.
I mean, basically, this country is shooting itself in the foot with tax rates. So this is sort of basically saying we don't want anyone to buy a property and rent it out, and if you are, we want you to sell it. And what it'll do is it'll tighten the rental market. But look at the amount of tax they're taking from it. Look at the position the government is in and our dreadful budget deficit. And then, so a colleague of my wife told us the other day, they are from the Philippines, and they have to pay £4,000 a year to the government. They're a nurse, and they pay roughly half of it is because they are an overseas person working in the UK. And they also have to pay roughly half of that for access to the NHS.
Christ.
I mean, and all of this money has gone into the tax take and continue to go. Is it, insurance premium tax, 15% now, I think. All this money gets slurped up by the government and then splurged in an utterly wasteful manner.
Well, there's not enough of it, Richard. Have you seen the size of the deficit? I mean,
I know there's not enough of it. So what are they doing with it all, Keith? Slight digression, but it's the appetite for this government, for our government, for tax and its ability to take more and more tax and produce less and less is extraordinary.
Well, frankly, Richard, you just need to listen to Radio 4. They're always saying, oh, we need to spend more money on X, Y, and Z. The answer to every social ill is more spending.
Yeah. What has to happen is that all government services have to view themselves as a service, not as a, sorry, I will say this, you can cut it out, Keith. They have to view themselves as a service centre, not as a self-importance centre. And that way, they'll change their attitude to what they need, what they should be doing, and they'll start to do their job better.
Actually, Richard, I disagree. I think that we have aspirations to sort of social equity that we just can't afford.
That's true. I completely agree with you, Keith. Well said. So, UK mortgage approvals are in free fall and remain 40% below pre-pandemic levels. Not good.
Yeah. UK construction sector, housing sector will have to slow.
And German GDP shrank by 0.4% in quarter four. German IFO business survey data all improved in February. They all missed expectations and they're all below 100. It's not, the European economy, I think you can read for Germany, read Europe, is sputtering.
Yeah, and we might remember that Germany essentially it specialized in goods, and we know that kind of goods expenditure had this extraordinary surge during the pandemic and is now fading. And Germany has specialized in big durable goods items and things like cars. You notice that China has now become a huge exporter of cars.
Yes.
And you wonder whether actually Germany is going to have to retool itself less towards manufacturing.
And energy prices are still very high relative to where they were a year and a half ago now. And that is going to have a long-term degrading effect on German industrial production, European industrial production.
Yeah.
Eurozone credit is tightening. I mean, I think this is what we'd expect to see. They've stopped doing QE. Interest rates are going up. And presumably all European banks are tightening up their lending criteria. And we have a deeply negative global credit impulse, which is suggestive that the corporate earnings are going to fall. I think the only exception to that is China probably is not.
Yes. Yeah, agreed.
So that'll be pushing in the other direction. So what have we got? We've got a strong bounce in US economic activity in January, but query somewhat a result of a tax change, policy change, which would be a bit of a one-off. Measures of current US economic conditions show economic activity is improving, but the US jobs market is being supported by a reluctance to lay people off. But there's also quite a lot of contradictory data in the US jobs market.
Yeah.
And we're not really sure what's going on there. If the US economy turns down a little bit, there could be a bit of an avalanche of layoffs.
Yes, I agree. I think that just because the layoffs that we've been predicted haven't happened doesn't mean they won't.
Yeah. And global credit conditions are tightening. So excess savings built up during the pandemic have been exhausted for the bottom 80% of the population, of the US population. Probably the same here. Rising interest rates are raising debt servicing costs and cut spending, so that's all bad news for the economy. Monetary policy works with a lag, which we know and we can see that is the case. And so we expect the US economy to continue to slow down in the coming months. And I would say to that, I would say European and UK as well.
Yes, precisely, Richard. But we've been saying this for a while now, and it hasn't been true. The economies have been resilient, they've bounced much more than expected. And so you've seen this big rise in interest rate expectations over the last month as inflation's proved persistent and the economy is resilient. But we on this podcast stick with our prediction. In fact, the more I see of the data, the more I think we're right. It's just the monetary policy lags have been longer than we were expecting.
Yeah, I completely agree, Keith.
And, well, because of the extended nature of our news coverage, we're only going to do one section this week, and that is on US residential construction employment. Now, regular viewers will know that we think the housing sector is crucial to the economy because, although it's a relatively small part of the economy, it's very cyclical. And so when the construction sector turns down, it sheds jobs. And that starts the recession. So this is construction sector jobs as a percentage of total employment. And you'll see when it turns down sharply, that means a recession. Now, this time, it hasn't turned down sharply yet. And within the construction sector, it's residential construction that is particularly volatile. And so when looking at the construction sector, we should be particularly concerned with the housing sector. This time around, we've had a fall in home construction starts and permits, that's the blue line, but units under construction have continued to rise and are at a record. So what's happening is that units under construction appear to be taking a very long time to complete and are still rising despite the fall in starts. So building permits now down 20% of their peak and are forecast to keep on falling. In previous cycles, and this is in 1973, there has been quite a short lag between the fall in permits and the peak in construction and construction starting to fall. So in 1973, you're talking a 6-month lag. In 1980, 6-month lag. 1987, 5-month lag. 2008, 5-month lag. So the peak in starts and permits was followed 5 months later by the peak in units under construction, which then began to fall. Now, this time round, the peak in permits was in April 2022, and we still haven't had the peak in units under construction. And that is why employment in the construction industry has not yet turned down. And it seems that what's happening is that during the pandemic, there was a large number of starts, interest rates were very low, and construction companies have just not been able to find enough staff. And so these completions are taking much longer than expected, and hence ongoing construction is keeping employment high.
Now, so it's a bit like, Keith, that if the standard duration of building a property is 4 months, it's a little bit like the standard duration has gone up to 8 months.
Yeah, exactly. But eventually they'll still complete them.
They will come out at the end, won't they?
Yeah.
Yeah.
And if the normal relationship between the fall in permits and the fall in employment holds, then we should see a fall in jobs of between 600,000 and 1 million later in the cycle. But this cycle is taking longer to play out, but the cycle will still happen. Now you see here, just the units under construction are at a record high. And construction employment has held up. When that starts to come down, you should see employment coming down. And in January, in the JOLTS job openings, we saw the first indications of that happening. So if you just look at the construction job part of JOLTS, then job vacancies fell by 250,000 in January. And this is job openings, and you see massive drop suddenly. So 1 month's data does not necessarily make a trend. It's volatile, but it may be starting.
That is actually consistent with the plateauing of the number of under construction, isn't it? Because basically employers are now saying, we'll keep the workforce we've got. We don't want anyone new.
Yes, good point. So this is a quote from an analyst. Why has construction sector employment held up so well, despite the fall in housing demand? The immediate answer that comes to mind is labor hoarding. For 2 years, employers across the US have struggled to find workers. The construction industry is no different. Perhaps firms are holding on to workers even as demand for homes is dropping because memories of the employee shortage are still fresh. Based on this reasoning, it is a matter of time before the bottom does drop out of housing jobs. This is exactly the same as is happening in the manufacturing sector.
It's very interesting, Keith.
So one sector which absolutely is shedding jobs is estate agents. And you see on the left-hand side, you see that real estate agents have fallen by, 50-odd thousand? And if historic relationships hold, then construction worker jobs should follow with a lag. So in summary, the construction sector and the manufacturing sector lead the economy into recession. Although they're not huge parts of the economy, employment in those sectors is volatile and cyclical. So currently, we know that permitting activity, mortgage applications are falling, and that means that in the coming months, fewer new projects will be started. And at that point, the construction sector should start to shed jobs and normal recessionary dynamics start to play out. On to other charts, Richard.
Thank you, Keith. This is a China reopening composite index. Look at the way it's shooting up from the beginning of this year. So it's built using various daily sets. And as you can see, it's built using various data sets, but it is it's growing as fast as it fell in the COVID period. China will see major tailwinds from easing of credit conditions. Basically, the Chinese government is chastened, as we're probably putting it too mildly, by the population's response to the COVID lockdowns. And it is absolutely desperate to get the Chinese economy going again. It will do anything to keep the Chinese property market going. And if that means it has to print trillions of yuan, it will do so. Okay, so this is a little look at Japan's population problem. So Japan isn't alone in having this demographic problem, but it's got it big time. And as we see here, in 2022, deaths exceeded births in Japan by 780,000. And births fell to a new record low of 800,000. Now, presumably, the replacement, just a simple replacement, we need to have births at 1.68 million, so or 1.58 million even, and which is double, isn't it? Double the current birth rate. So the Japanese economy is in the midst of this real burgeoning demographic crisis, which the UN, unless something happens significantly to the Japanese birth rate, is forecasting a deficit, reduction in the Japanese population, 600,000 a year in the coming decades. And I think the Japanese population is about 100 million, isn't it?
Well, here it peaked at about, was that 128 million?
Yeah.
And, you know, on these forecasts is going to fall to 75 million by the end of the century. I mean, that is a huge fall.
It's even on the face of it means the economy is going to decline by 40% or so.
Yeah, absolutely. And they've already got a huge debt burden, Richard.
Yeah.
So how are they going to service their debts?
Well, they'll have to have a lot of babies, so the babies can be born to service the debt.
Yeah. And of course,
slave economy.
But these projections also mean that the Japanese economy will become increasingly elderly. They'll have fewer and fewer workers to service both the debts and, the elderly retirees.
And the only thing, if the population dynamics stay as they are, the only thing that can fix it is massive increases in productivity.
Yes. Yeah.
Which roll in artificial intelligence, robotics, and machine learning.
Yeah. Magic wand. Thank you, Richard. On to good news. Now, this week, this is sort of an information service because it turns out that vitamin D, if you take it regularly, can stave off dementia. And so we should all be taking vitamin D supplements. So researchers looked at 12,400 patients with an average age of 71. And those who took vitamin D had 40% lower chance of developing dementia. In fact, across the sample, you're looking at about, 20% of participants developed dementia. And of those, 75% of them didn't take vitamin D supplements. So, as you get older, you should take vitamin D as a prophylactic. But, it seems that, as in everything else, we are finding ways to stave off all these diseases of old age.
I don't know what the dosage should be, but vitamin D is in fish oil capsules, isn't it?
Is it? Well, it's also,
I'm sure everyone can tell that I'm not suffering from dementia, and I actually do take fish oil capsules.
Really? Oh. Well, the other thing you could do, of course, is you go and retire to the beach and do some sunbathing, because vitamin D
that's vitamin E, isn't it?
No, vitamin D, mate. He says. No, I don't think it.
Supreme confidence.
Yeah. Yes. No, vitamin D is manufactured in the skin. And on to equities, Richard.
Thank you, Keith. Well, it wasn't a very good week in the stock market, was it? Everything down plus 2% or more. Bitcoin down 16%, completely fried by more of these exchanges and so forth are going. What was it? Silver something or other went into voluntary insolvency. So basically, pretty bad news for most risk assets, apart from the topics. I don't really understand why the topics has went up like that, 2.2%. And the VIX up 9% on the week.
Yeah, I have followed the strategy. I sold it when VIX went below 20, and it is my only bet that's making money at the moment. But sadly, it's the tiniest bet. It's £1 a point, so I've made like 45 quid. So
it's an interest as opposed to an income. Well done, Keith. So Bitcoin is very volatile. So I think if it drops below about £15,000, then it's going to go further, isn't it? But it could bounce up and down between £25,000 and £15,000, and it doesn't really mean much. So there we have Bitcoin. The commodity chart of the week is the SPAC EV car makers 2022 production forecast versus actual. So it is Lucid, Nikola, and Lordstown Motors. And so they forecast, actually, they're each forecasting large quantities of production. And they each achieved, actually, I think Lucid and Nikola have achieved quite commendable results, haven't they? Lordstown Motors is clearly a dud.
Yeah. Well,
SPACs have just, anyone who invested in a SPAC, very sadly, probably lost all of their money.
Yeah.
And as Keith has put there, do not invest in fads.
Yeah.
And don't invest in IPOs, because the fundamental reason for not investing in an IPO is that all of the cash has been taken out by, all of the value has already been taken out by the people doing the IPO.
You can make a decent money on the pop in most of these cases, actually. They time the IPO quite well. So, but then you don't want to hold it.
And also, you've got to bear in mind that everyone else is trying to make the money on the pop. So it's not as easy as it looks.
Yeah.
Equity market bottoms coincide with housing market bottoms.
Yeah.
Right. Well, I suggest a little way to go, yeah.
Yes. Pause, take a look.
The yield on the Treasury versus the dividend yield. And this is a why stocks will crash. A 2023 type of chart. So you can see the S&P dividend yields is pottering along at 2%-ish, a bit down from that now. And the Treasury yield has basically skyrocketed, as we all know. This is one of these sort of somewhat illusory charts where there isn't really a correlation, but you can see what they're getting at.
That's right, Richard. There isn't a correlation, but there should be. Because, if you're thinking about where you're going to put your marginal pound, as you can see from the chart, you can make 5% by putting your money in a bank account for the next year, or you can make 1.7% dividends by putting it in the S&P 500 with a lot of risk. Surely you should demand a higher yield on equities to invest in them at this point. But it seems like investors are currently not doing so.
And 6-month Treasuries currently yield 5.3%. And the S&P earnings yield is 5.3%. That's earnings, not dividends. So you should, all other things being equal, be buying Treasuries. Clearly, all other things aren't equal.
Yeah, particularly when we know that earnings forecasts are falling. And as we covered, I think, last week, with almost all S&P 500 companies now having reported their Q4 earnings, their generally accepted accounting practice earnings have fallen by 28% year on year, as opposed to their self-reported earnings using EBITDA and all the other junk. Oh, here we are, in fact.
So as Keith was saying, 92% of S&P 500 companies have reported Q4 earnings with GAAP EPS growth of minus 28%, which I think validates what we've been saying here for the last 12 months.
Yeah, but the market hasn't reacted. It's absolutely extraordinary. We've been forecasting.
But the reason I think
would fall. Go on.
I mean, who knows, Keith? But the reason I think they haven't reacted is because everybody's anticipating that interest rates are going to drop dramatically, and the stock market is going to carry on going up as it did before. And it takes time for people to understand that just because that's what happened over the last 10 or 15 years, it won't necessarily happen again. So interest rates may well fall, but I don't think the stock market is going to go off to the races in the way it did. But I may be completely wrong.
Well, you and me both, mate. Been wrong so far.
2 weeks ago, all of the February return on the S&P 500 was from the FANGs plus Microsoft, Nvidia, and Tesla, now known as the Mint stocks, which is interesting. It means all the other S&P stocks between them didn't return anything.
Yeah. So essentially, we've had been a big bounce in tech.
It's tech, yeah. So the mega cap tech bubble is large and is not yet down to the size of the 2001 tech bubble.
I think dead cat bounce.
I agree with you, Keith. And I think tech is a good long-term investment, but I don't think it's now. I think it's in a while. The US equity market has massively outperformed the rest of the world. And for example, the UK market, as we all know, basically is unchanged in 20 years. Had a bit of a decent start for this year. And the US market is far from unchanged in 20 years. It's up fivefold, threefold, whatever you take your point from.
But it's strongly mean reverting, this chart.
It is, isn't it?
So,
yeah. But over a long period of time, Keith.
That's very true. You're talking actually 30 years peak and drop, but it mean reverts.
Yeah. And correlation between stock and bonds remain positive, which suggests that the equity market is not concerned about there being a recession. As
we've talked about before, if earnings are flat and don't change, then you can regard equities as just like a bond. It had bond-like cash flows. And so when the market is not expecting much change in earnings, then you should have a positive correlation between bonds and equities. Okay, so Richard, look away now. I'm going to ask you.
Oh, right. Are you ready? Yeah. Okay.
Okay, you got to guess. We're going to play a little game now. You've got
Right.
to guess what the PE ratio is on various stocks in the US. Okay. From prejudice. Okay, so Walmart, big consumer staples like cheap shit.
Given the nature of your question, and I'm not looking at this, I haven't seen it.
Yep.
Given the nature of your question, I'm going to say Walmart is 35.
Actually, not bad. 45.
45.
45.
I mean, I thought I pitched it high, Keith.
Yeah. Okay. Colgate Palmolive.
Colgate Palmolive, 22.
Yeah. 34. I mean, these like tech-like PE ratios. I mean, it's mad. Hershey makes chocolate.
Chocolate. I would say that should be on around about 18.
Yeah, I personally would say about 12. 30.
30. Okay.
So Paul's take a look at the PE ratios. I mean, they're consumer staples, which is a low growth industry. Why are they on, these huge PE multiples?
Wow. Estee Lauder, 61.
Yeah. These are not high growth industries. Walmart.
There's a long way to go there, isn't there?
Yeah. So to me, in my mind, it just looks like the US market is just overvalued. Okay. And on to commodities and energy commodities. Well, generally a bad week. Oil continued to drift off, down 2.7% over the last 2 weeks, of course. Natural gas in Europe down 10% over the last 2 weeks, and in the UK down 7%. So that's all good news. Despite the recent cold snap, gas prices in Europe are continuing to come down, and they are down 40% in Holland, in Europe, over the course of the last couple of months. In the US, natural gas prices seem to have hit a bottom, down 44% on the year. Coal continues to drift off, down 14% over the last couple of weeks, down 54% year to date. Uranium up 4.5% year to date, and very much defying the trends in the rest of the energy sector. Some numbers pertaining to the oil market in the US. We've had a drawdown over the last couple of weeks of 1.1 million barrels. Now, remember that prior to that, we're having sustained builds, and actually inventories in the US are up 52 million barrels year to date. So that's interesting. Has the US oil market once more returned to deficit? We'll have to wait and see. US crude production actually dipped down over the last couple of weeks by 100,000 barrels a day, and is now up only 200,000 barrels a day year to date. The Baker Hughes rig count continues to fall, down 15 over the last couple of weeks. This is Brent towards its lows. Now, this is a very interesting piece I read in the FT this week, and it's talking about the oil market and how it responds to near-term shocks and anticipated future shocks, such as China reopening, for example, or a future change in OPEC policy. The point was that the oil market reacts hard to near-term shocks, but not very much to future shocks. And the reason is that there's a very large cost of storage. And so when you see a future demand or supply shock, then you have to include in the anticipated return the cost of storing the oil. And also, the oil market is quite flexible, so there will be changes in supply and demand in anticipation of that shock. So the market basically reacts much less now. OPEC, of course, had previously said they were going to cut production by, I think it was 2 million barrels a day or something. But they haven't been. frankly, their production is up year on year and year to date. And retail investors have been giving up on oil companies despite the very strong profits and free cash flows we've seen over the last couple of years. And there have been net outflows from energy ETFs, which is surprising. Okay, these are European natural gas futures. Have they now found a bottom? And natural gas is now cheaper than coal again. So that means natural gas should hopefully have found a bottom, because power companies will switch back to using gas rather than coal. These are UK natural gas futures, way down from their peak. But if we extend the chart, still more than double what they were pre-pandemic. So we're still paying a lot more for our energy than pre-pandemic, and that's bad for inflation and the economy. And this is the UK national grid over the last week, and it was 52% powered by gas. So we remain heavily dependent on gas, although we also imported 8% of our electricity from the continent. Pause, take a look if you're interested. This is US natural gas. Coal still falling. Uranium resilient. Richard, industrial commodities.
Thank you, Keith. But if you cast your eye down this table, you can see that industrial commodities also had a bad week last week. Universally down, apart from cobalt and ferrovanadium, and some big drops in lithium, neodymium, nickel, and tin. So, and if you look at the year to date, it's quite interesting. The only three that are up year to date is copper, iron ore, and ferrovanadium. All the rest of them down. So I think copper and iron ore are probably strong because of China reopening. And ferrovanadium, I don't know why that's strong particularly.
Well, it's also used in steel, you know.
Yeah, good point, Keith. Good point. But basically, the world seems to be anticipating a fairly significant slowdown in commodity usage, and hence a fall in pricing.
Yeah.
There we have aluminium, cobalt, which is just a bizarre graph.
Yeah.
Copper. Bear in mind that copper is in a long-term deficit at the moment.
Yeah.
And also bear in mind that all of the materials that are renewed for the renewable renaissance are in massive deficit.
Yeah.
Chromium, iron ore.
Yeah. Is that peaking?
Difficult to tell, isn't it? But I wouldn't expect it to go up very much higher. Lithium has come back very sharply from its high in late 2022. It's nearly halved.
Yeah.
And there's been a phase down in subsidies on electric vehicles because it costs the taxpayer too much money. And also they're introducing legislation, I think, gradually, aren't they? So it's legislatively imperative to buy an electric vehicle, becoming more so. And so obviously that's had an impact on demand for materials that are required to make electric vehicles.
Yes. And when you're talking about cobalt, you know, that's key element in batteries.
Yeah.
You know, EV sales is that pretty much halved, actually.
Yeah.
So, you know, big knock-on effects on lithium and cobalt.
Oh, so Iran has now discovered a huge quantity of lithium. And presumably, if they wish to, they can get it into production without too much bothering with environmental conditions.
Well, you know, 2 weeks ago, we were talking about how India had found an enormous lithium deposit. The fact is, we hadn't much use for it, so we didn't go looking for it. Now we've gone looking for it and found loads of it.
Yeah. Neodymium, nickel. So London Metal Exchange is being sued for $500 billion or pounds, I forget which, by various parties after the debacle they had last year.
Yeah.
Tin, ferrovanadium, zinc. All of these charts are terribly volatile. So precious metals, So it's interesting, quite a divergence between gold and the others. So gold is basically unchanged year to date, pretty much unchanged on the week. Silver, platinum, palladium, and rhodium down between 16 and 24% year to date, and quite big movements during the week. So gold is actually, I think, maintaining its position as a safe haven. You know what's happening in bonds and the stock market, whereas the others are much more susceptible to the vicissitudes of the industrial marketplace.
Yeah, actually, gold's performance over the last couple of weeks is really impressive given the rise in yields, because you would expect it to have fallen, but it didn't.
Yeah, that's right. So there we have the price of gold. It's sort of, I suspect that it is consolidating at some point. It's going to break out above that 2000 level. One of the things we didn't mention, of course, about US treasuries and the difficulties the US government's got in getting them away is that because of what they've done with Russia and basically repudiating the contracts treasuries, it's bound to remove demand for holding treasuries from sovereign states. Perth Mint, basically, I think what it did, it made a mistake. And then rather than saying, sorry, we've made a mistake, they proceeded to continue with it and cover it up. And now they are in a real mess.
Yeah. So do you know what's going to happen, Richard? Because, I mean, this seems just extraordinarily silly. So in order to kind of make a small bit of money, they were diluting the gold, and then they just didn't do it very competently and over diluted the gold.
Yeah, I think well, I think they've trashed their reputation, haven't they? So they've done themselves enormous reputational damage. I think if they have to re-smelt 100 tons of gold, the total cost is their liability. It's going to cost them a great deal of money.
Yeah.
And I don't know what it does to their future. And central banks continue to buy gold in January, 45 tons in January. 77 tons in January, of which Singapore bought 45, which is a lot.
Yeah.
I wonder if UK is buying gold, because obviously Gordon Brown sold most of it, didn't he? But I do sincerely hope that we bought most of it back.
Yeah. Giving them funny bits of paper instead.
Yes. Excuse me. So there's the silver price chart. Platinum. These are long-term charts. It's interesting. Really, these haven't changed much over the last 8 years. Rhodium, which obviously has changed quite a lot.
Well, yeah, it seems like there's been a bubble in rhodium, frankly.
Yeah.
It's fading fast now.
Yeah. Palladium.
Okay, thanks, Richard. And on to rates. Well, it's been a bit of a roller coaster over the last couple of weeks in rates, because over the last couple of days, they've come down again, having risen sharply. So over the course of 2 weeks, the UK 1 year has only actually risen by 3 basis points, and the 50 year has actually fallen by 1 basis point. So not much change, but that masks a bit of a roller coaster ride in between. In the Eurozone, similar, although the Spanish 10 year rose by 10 basis points. It's very interesting that the Italian yield is down quite sharply since the start of the year. So the market is really not worried about Eurozone risk at the moment. Now, this is a chart which Richard will find amusing, and this is economists' forecasts for inflation. And you see, essentially, they always come down at 45 degrees towards 2%. They always forecast it's going to return to 2%, and they're always wrong. So in the UK, Citigroup have revised down their estimates for UK gilt issuance for 2024, but it's still very high by historic standards. And you'll see there's a break in this chart from the pandemic onwards. We are borrowing systematically more money, and that has negative implications for yields. And fundamentally, we need to get the deficit down. We have raised taxes, but we haven't cut spending enough. And we talked about this earlier, but the ECB seems to be losing credibility. You know, look at 10-year inflation break-evens, and they're higher now for Germany than they are for the US. And that is very much a change from the last decade. and 6-month treasuries now yield the most since 2000, so 20 years. So we have had a really very sharp rise in interest rates in the US. And frankly, I can't see how that doesn't slow the economy. I think it has to. It's just happening slower than I expected and with a lag. And this is a really interesting chart. So this is CDS on US Treasuries and 1-year US Treasuries. And it shows that the market is actually quite worried about a US default. In fact, it costs more to insure US government bonds, 1-year government bonds, than it does Peruvian, Chilean, Mexican ones. So this is the UK 10-year, bit of a roller coaster ride over the last 2 weeks, but long-term bond yields now hopefully coming down. 30-year. So today the equity markets are falling because of the problems with Silicon Valley Bank, and that has caused a bit of flight to havens, safe havens, and I think that is causing government bonds everywhere to catch a bid. But, we've been here before. A short downturn does not necessarily indicate a new trend, although I wish it did. This is the US 10-year. German, Italian, Greek. Any change to your views, Richard?
No. No change to my views, Keith. And you?
No, actually, despite having lost loads of money on my bond trade, the more I look at the data, the more convinced I am I'm right. So I haven't cut it. I've stuck with it. And I think it's going to come good.
I think you will be right, Keith. I think you'll be right. I think it's, as we've said several times this podcast, it's taking longer than we thought.
Okay, so concluding comments. Well, everywhere, sadly, inflation appears persistent and economies surprisingly resilient. Even the UK actually had an economic bounce in January. So it's going to be very interesting to see how the data evolves over the next few months. Continue watching the weekly checklist. Interest rate expectations have risen sharply over the last couple of weeks since the non-farm payrolls. This afternoon, we get to see how much of that non-farm payrolls was the result of seasonal adjustments, which may have gone awry. But bottom line, I still expect a recession in the second half as increasingly tight monetary policy finally has an effect. Richard, what did you get up to this week?
Thank you, Keith. So I've the last couple of weeks down a bit. The FTSE all shares down a bit more. So my relative performance is up 1.5%. I haven't done anything, no purchases, no sales. As you know, my main exposure is precious metals, where gold has stabilized nicely at the level it's at the moment, having had a bit of a nasty fall. Silver's down a bit more, but I'm very comfortable with my holdings in those assets and continuing to really try and sit on my hands as much as possible. How about you, Keith? How's your week been?
Thank you, Richard. Well, I have been away in Tokyo for much of the last couple of weeks and done no trading. But net over that period, government bonds continue to sell off, although they've rallied in the last few days. I lost a further 1%, taking me down to minus 2.5% on the year. But frankly, I'm increasingly confident in this bet, and I will be sticking with it. So I'm down, obviously, much worse than Richard, much worse than your share, but, feeling quite relaxed about it, which was not the case before I went to Tokyo, actually. I think sometimes it's quite nice to step away and,
Yeah, I think it's becoming a little bit clearer where the top of the interest rate cycle is going to be now.
Yeah.
I think that is clarifying, and I don't think we're terribly far away from it. And that is the point at which the trade that you've got on will stabilize, isn't it, Keith?
Yeah, no, I agree. Okay, only want to talk about one stock this week, and that is a UK oil exploration company that I previously held called Pantheon Resources. Now, I've been slightly mystified by the price performance of Pantheon. So Pantheon have exploration assets in Alaska, and there's been quite a lot of talk on Twitter by oil industry experts saying essentially that these assets were uneconomic and that the company was just vastly overvalued. Now, I bought it back in 2021 at 39p. And when it hit 80p and I doubled my money, I thought this company, it was then worth something like $500 million. Must be more than that. And I thought for an exploration company with no production, that's just too high. And I sold it, making 104% return. Well, it went on to double again, pretty much, hitting a peak at almost 150. And then it was valued at $1 billion. And I was just absolutely mystified by what was going on. And it just shows you that investors can get carried away because it's now had the results of some drilling and it hasn't been great. So it seems that there are hydrocarbons there, but the commentary I've read is that the break-even rate would be well in excess of $100 a barrel. So even now, the market cap is 220 million, down from like $1 billion earlier. And that seems way too high to me. I think it's got further to fall. And the other thing is, I'd previously lost money on Pantheon because the last time it had a great discovery in Texas and market commentators were, this is going to be marvelous. Well, it didn't turn out to be marvelous. The initial excitement over the prospect turned to disappointment when essentially they ran into drilling difficulties attempting to exploit their earlier discoveries.
I think you did really well there, Keith, because if you look at both of these charts, and particularly one on the left, there's no way that you would have held up to 160 and then all the way back down to 80 in that first spike in order to gain the 200. And with when things are this volatile, I don't think many people make money on them.
Really? Yeah, I think
holding it all the way is so hard.
Yeah, I mean, the thing is, we've talked about this before. Sell discipline is so important. And actually, Richard and I will be recording a My Worst Trade this weekend, talking about the exit strategies and the need to have one. So I hope you will watch that, hopefully out on Sunday. And this is the price of 2071 gilt, which I own. And, is that a bottom? We hope so. This is the US 20-year plus Treasury ETF now, and this is on a slightly longer timescale. You see, it peaked during the pandemic at 500, and it hit a low of 310, and it's ticked up a bit. Now, is that a bottom? As interest rates come down, I fully expect that to head back towards 400. Would not seem unreasonable. 370, 400. And this is 2068 index-linked gilt. Now this, not so long ago, you'll see this chart starts 1 year ago when the price was over 250. It peaked at 300. Yeah. So it's now at 80, 85. Now, as inflation comes down and interest rates come down, I'm fully expecting that to move up at least towards where it was only a few months ago, 125, 150 last July. That'd be half of what you paid for it during the pandemic. And reminder, the Bank of England is actually forecasting deflation in the next couple of years.
That was one of those graphs, Keith.
Sorry?
That was one of those graphs.
Yes, exactly. That's right. They just carried on that 45-degree angle to Infinity, right? Minus infinity, right? So anyway, this is the 2040 index-linked gilt, and I commented that if interest rates continue to rise, then I just stick all my money in this below 100. Well, it's did briefly go about below 100, and it's now at 102. But for long-term investors who pay higher rate income tax, this is a really good deal, because you're now getting best part of 0.625% in interest plus inflation tax-free. And that's it. So thank you all for watching. Please, can you press like and subscribe to the channel? And good luck out there. It's volatile. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.